Good morning. My name is Victor Ali, and I'm the head of investment strategy at Sankore Global Investment. And here's your wrap for the markets last week. In spite of the fact that the Federal Reserve, at the conclusion of its meeting on Wednesday, had basically guided to the fact that it wasn't likely to cut rates starting in March as the market had expected, very strong job numbers that we saw on Friday, and also strong earnings from the likes of Microsoft and Meta really saw the US market closing very strongly last week. Essentially, it's 13th positive week in 14 weeks. The Dow Jones added 1.43%. The Nasdaq was up 1.12%, while the S&P gained 1.38% for the week. The job numbers that we saw last week came in at 353,000 jobs created in January. This was almost double the expectation of 185,000 jobs that the market had going into that job numbers. We also saw hourly wages increase by 0.6%, essentially double the expectation, while wages jumped 4.5% year on year. Unemployment stayed steady at 3.7% against an expectation that we're going to see a 3.8% number. Now, this again just demonstrates the continued resilience of the job market and by extension, really the US economy. However, the question it does raise is at what point does the Fed start to cut rates really? Again, like I said earlier, the Federal Reserve Chairman had hinted at, not cutting in March. And of course, not cutting too soon, as well as, that could amount to a defeat of the purpose that they are trying to attain. Again, going into the remainder of the week, analysts will certainly be looking out for more earnings. Companies like McDonald's and Ford are set to report their earnings this week as well. If you look at the earnings landscape so far, about 80% of companies that have reported have beat earnings estimates. This is slightly above the trend that we've seen over the last couple of years of around 76%. Also, the tensions in the Middle East will be something that market analysts will be keeping an eye out for as the US commenced strikes against Houthi positions in Iraq and in Syria in what it has described as the beginning of its retaliation, against the strikes that killed 3 US servicemen at a military outpost, in Jordan. Over in China, stocks have basically continued to suffer losses. The CSI 300 index is basically hovering around levels that have not been seen since 2019. However, the cash reserve ratio, the cut in cash reserve ratio, we expect that to kick in today, which is going to free up about $139 billion. This should help to address some of the liquidity crunch that we have witnessed in that economy. And that should happen just before the week-long lunar holiday kicks in China. And back home, it was a very, very interesting week, last week. We had, quite a flurry of, CBN circulars that were essentially aimed at addressing, the FX issues that we're currently facing. First of it was the, circular around the net open position limit for banks, where the CBN essentially stated that banks can no longer carry any long position for their net open position. What this basically means is that the banks cannot hold more assets than the liabilities that they have in FX. And if they do, the CBN essentially gave them up until the 1st of February to normalize that. What that would mean is that the banks will have to reduce those positions by selling. Now, by our estimates, the banks are having to sell anywhere between $3 and $4 billion in cash to try and meet, this prudential guideline by the CBN. So far, we saw a knee-jerk reaction in the market on the first day. Following that, not much has happened. We, however, think that the banks are likely going to, get some forbearance from the CBN, as it will probably take a bit more time to get rid of those positions and also normalize. We've also seen a circular from the CBN, essentially removing the caps on the quotes that international money transfer operators can provide to would-be buyers of USD or transfers of USD. Now, what that seeks to do really is to ensure that all of the diaspora remittances, which is estimated around 20 billion by the World Bank for last year, all of those essentially get into the foreign exchange market, because about 90% of those remittances have been externalized. Essentially, because those rates had essentially been capped, people have basically consummated those transactions outside of the foreign exchange market, where most of it still sits abroad. So the idea with the removal of this cap is to ensure that a substantial portion of these remittances get into the foreign exchange market in Nigeria, and this will certainly help to significantly improve liquidity. So all of the circulars that we saw last week were essentially aimed at improving liquidity in the FX market. The attendant impact of which really remains to be seen. Like I said, we saw a knee-jerk reaction in the aftermath of the release of those circulars. Since then, things have kind of stabilized. It really remains to be seen whether this then becomes sustained in terms of the impact that the CBN does expect. Now, onto the fixed income market. In a bid to mop up excess liquidity last week, the central bank conducted 2 OMO auctions where, the long end paper closed at 17. And this basically created a bearish trend or a bearish sentiment in the treasury bills, markets, where we saw yields expand by about 64 basis points across that treasury bills curve. The bond market was largely, the trend in the bond market was largely determined, by the outcome of the bond auction that we had on Monday, where yields basically closed higher than their secondary market levels. The 2027 closed at 15%, the 2029 closed at 15.5%, the 2033 closed at 16%, while the 2038 closed at 16.5%. So, in the aftermath of the auction, we saw, secondary market rates basically reprice, upwards, and we saw yields close higher by about 77 basis points across curve. The market is still looking towards the MPC meeting that is slated to hold at the end of this month. Nevertheless, the guidance has also been provided for the PMA auction that is going to hold on Wednesday, and the CBN is looking to mop up about ₦1 trillion from the system. So that itself is going to have, a major impact on yields going forward. We think that this will put an upward pressure on yields and would likely increase yields, going forward. We'll continue to keep an eye out, for maybe further direction or circulars from the CBN regarding the FX situation and the impact that is likely to have on the fixed income and by extension, our financial markets as well. Thank you very much for your time and attention. We do hope that you have a productive week. Thank you.